What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be taking a look at Oracle stock, and we're going to do some stock analysis to find out if this stock is currently a good buy. So, first thing on our list we're going to look at is the stock chart. And what you will see is that over the last 5 years, the stock's up 72%, so not too bad. And then the last year, it's up a little bit under 17%, which is also not too bad. So, if you don't know, Oracle primarily makes their money from selling subscription services for their software, and most of their software is cloud related products. So that's the majority of their business. They also make some money from hardware, but I believe about 83% is coming from that cloud software business. So this company has a market cap of $232 billion. They are a pretty large company. And if we take a look at their revenue, we can see that it's grown almost every single year. And last year, they did $42 billion of revenue. Net income, they did $6.7 billion of revenue. And then the year before that, they did 13.7. So we saw a little bit of a drop off in 2022. But for both of those, I would give them a check. I would consider revenue and net income to both be improving over time. As for their valuation, I want to give this a no, because they're currently trading at 26 times 2023 net income. So if we look at the history of this stock over the last decade, what we're going to find is that it normally trades at around a 17, maybe up to a 20 PE ratio. Well, right now we're trading at 26 times. So that is a bit higher than where we normally should be trading. I don't believe this to be a healthy position, a healthy valuation for the stock. I would say 22 should be the highest. So I would expect this stock to come back down to 18 or 19 times earnings sometime in the next year or so. That's why I don't think this is a great time to buy in. So that's going to get a no. 26 times earnings is not the greatest number. If we look at how much they're growing earnings, we can see that, for one, it dropped off by nearly 50% last year. And then this upcoming year, it's expected to be the same. And then 2024, it's expected to grow quite a bit. Revenue is growing anywhere from 17%, and then it's expected to decelerate to 7% next year. So not like phenomenal numbers or anything, nothing we should be paying 30 times earnings for. Are they innovative? Do they have a moat? This one, I was a bit unsure about, but I asked my friend Bryce, who works at Oracle, what he thought. He says he would consider them to be doing innovative things. Looks like they got a contract with Uber, with NVIDIA, and a couple other companies. So I guess you could consider them to have somewhat of a moat or be somewhat innovative. But I wouldn't say they're at the forefront of innovation or anything like that. But we'll give that a check, since they are a pretty large company with a large customer base and a company that has a lot of data. So number 5 is going to be, is the industry growing? Yes, the cloud industry is expected to grow at 20% per year. So they're definitely in a good industry. Return on invested capital, I put a yes. I believe it actually has been declining pretty rapidly. Yeah, we've seen it peaked in 2001 at 53%, and now we're down to 12%. So even though it's down a lot, 12% is still not a bad number. That's still better than a lot of other companies. So we're seeing anywhere from 12 to 15% for Oracle, and that's not bad. So we're going to give that a check. Healthy cash flow, no. No. Definitely not. Because what I don't like about this is, if we look at operating cash flow, what we're going to find is, initially when I looked at this, I said, okay, it's growing. It looks not too bad, right? We saw 14 billion in 2019 and 15 billion in the trailing 12 months. Well, that doesn't give the full story, because if we open this up, what you're going to find is net income actually went from 11 to 8. So it actually declined. But what is pushing this up is stock-based compensation. It went from 1.6 billion to 3 billion in the trailing 12 months. So that is a bit deceiving. I don't like seeing that. It makes me a little bit more suspicious of the way management is doing things. And so that's not good. I mean, operating cash flow doesn't look too good. Investing cash flow, they invested $30 billion and they only made $8 billion of net income, right? That's not good either. They're not in the greatest financial position. So their income is declining. They're investing 4 times more than what they're making, and they have way more debt than they do equity and income. Like, the balance sheet is awful for this company. Diverse revenue streams, you could maybe make a case for that, but I put no. It's how I said, it's 83% coming from the cloud software. So I mean, they have a lot of customers though, but not as many customers as like AWS or some of the other cloud companies out there. Like Google has millions of customers, Amazon has millions of customers. Oracle, I believe, only has it's something a lot less. If we look up, let's look up Oracle number of customers. This says has helped over 10,000 customers. Oracle has 5 million registered members of Oracle's customer. Okay, so maybe they do have a couple million. So either way, you can look at that either way. I mean, I think they're not selling too many different types of products. I don't know. Maybe if you break down the cloud industry and the subscription software business a little bit more, you can find different sources of revenue. But overall, I would consider that just as a cloud-based business. Growing equity, no. This is pretty much as bad as it gets. So if we look at equity, what we're going to find is in 2019, 4 years ago, they had $22 billion. Phenomenal. Then the next year went to 12, then it went to 5. Then last year it went to negative $5.7 billion. So that's just phenomenal. Now we're at negative 3.7 billion. Still not good. So that's going to get a no. Equity is not over 15% of the market cap. The share count is decreasing. What's that noise? So the share count is decreasing. That's good. Healthy amount of debt? No, they have way more debt than total debt, $90 billion, right? $90 billion. And we're talking $7 billion of cash, right? Current assets, 17 billion, and they have $90 billion of debt. So they got a long ways to go. Respectable management, no. For the share compensation, for the equity, for the debt, for all these different things, I'm not liking it. Number 14, they do have more cash because they don't, well, actually, wait a second. Cash is 7 billion, right? Cash is 7 billion, and net income is, yeah, I believe it's, well, it's okay. This is like right on the border because they did 6 billion last year, and I would say no. I would say no because they're averaging more than that. So we're going to change that to a no. Healthy dividend, yes, they pay a 1.4% dividend and a payout ratio of 40%. That's good. And it is over 20 years old. The company was founded in 1977. So overall, this is going to get a 8 out of 16. I'm very unimpressed with this stock and this company. So I'm not interested in buying this anytime soon. I'd rather buy Apple or Microsoft or Google or pretty much, or Amazon, any of the other tech companies. So overall, not considered a buy. If you have any questions or comments, comment down below and let me know what your thoughts are. Thank you for watching, and I will see you guys in the next video.